Hello home buyers and real estate agents. The HUD-1 is going away, and I'm going to explain in detail how to read the new closing disclosure and what that means to you. But first, especially for home buyers, you want to realize what a real estate transaction is like. It's like dominoes. As you see on the picture here, you set up all kinds of dominoes, and that's the same as a real estate transaction. There's many little steps that need to be accomplished before we can actually close the deal. Now, if there's any one of these dominoes or one of these steps that are left out that isn't completed, then you're not going to get the deal done. It's not going to close. So it's so important that you have a system in place to make sure that all the little things get taken care of so there's not a delay, especially with this new law that says this closing disclosure form has to be complete and accurate 3 days before the close of escrow. Now, it used to be that real estate agents would forget to order a home warranty, let's say, until the last minute. Now, that could cause, if you get the invoice in from a home warranty company, which could have been ordered the day you opened escrow a month earlier or 2 months earlier, if you wait till the last day, you might actually cause the escrow to be delayed 3 days because of the 3-day waiting period to be able to look at the final numbers before closing. So again, it's really important for you to have a system in place. Now, I have what's called the TRANS-TRAC system or transaction tracking system. This is a template of what it is. You can look at that later. I'll provide a link. So when you hire a real estate agent, you want to make sure that they're using the TRANS-TRAC system to avoid any delays in your closing. Now, first, let's take a look at what this new form is replacing. As you can see, I'll provide the link to this webpage, the Consumer Financial Protection Bureau webpage, that shows, as you see, before there was a form called the Initial Truth in Lending Disclosure and a Good Faith Estimate. Those were two forms that would be provided by your loan officer at the time that you applied for the loan. Now, those two forms will be consolidated into one form called a loan estimate. I'm not going to go over these forms today, but I'm going to go over the next forms. They used to be a final truth in lending disclosure and what was called the HUD-1 settlement statement that gave you all the final numbers. And usually what happened is that HUD-1 settlement statement, you'd get an estimate before close, then it would close, and then after close, you'd get the actual final numbers. Now the new rule says you don't get an estimate ahead of time. You have to have the final numbers 3 days before it closes. And so those two forms are being replaced by the new closing disclosure. But you can go to this webpage and you'll see view the closing disclosure as a PDF here. I've got a copy of it right here. It's a 5-page long document. I'm going to go over in detail. As I'll scroll through it here, you can see all the 5 pages. But to understand the essence of this form, it's important for us to look at just page 2, and that'll be all the time that we need to, in this video for you to look at it. So on page 2, I'm going to make it a little larger. You'll see there's 2 sections: closing cost details. There's going to be the loan costs and then the other costs. I'm going to go over the other cost to start with and then go back to the loan costs. And I'm going to explain each of these individually. The recording fees, you've got a deed and mortgage recording fees. Those are typically charged by the recorder office at the county that you live in. So where your property is located, I'm in San Luis Obispo County, California. When I get a house and I get a mortgage, the deed has to be recorded, and there'll be a fee that the recorder's office charges to record that deed. And then there'll also be a lien on the property for the mortgage that will need to be recorded as well, and there'll be a fee to record that. These numbers are estimates or approximations, averages. Every county, there's over 3,000 counties, is going to have slightly different fees, and then also might be by state. There's also by state on line E2 a transfer tax. Each state's going to, again, be different. They'll charge a tax to transfer the title from one person to the next based on the sales price. Sometimes you can avoid that tax if it's a transfer between family. So if if I bought it as a house as a single person and I transferred it to my name and my spouse because I got married, there may be no transfer tax at all. If I transfer it into the name of my brother and I say it's a gift to him, but he's maybe paying me more than what I want to disclose, they're going to want to actually charge a transfer tax based on the value of the property. And so you want to make sure that whatever you disclose is going to be accurate, reflective of the actual transaction price. Next is what's going to be called prepaids. These are things that are paid ahead of time. Now you'll notice there's going to be F1 is homeowners insurance premium, 12 months it says. And then there's also Section G, initial escrow payment. They also list homeowners insurance $100.83 for 2 months. Let me explain why that is. First off, when I buy a house, let's say I'm the mortgage company and you're the buyer, and you come to me and you say, I want to buy a house. It's you're borrowing $80,000. It's a $100,000 house. And I look at you and I go, well, I'm going to give you $80,000, but I'm not going to give you this money, to buy that house, because I'm always thinking, the bank is always thinking, what if you, move in and burn the house down the day after you move in? Now, I want to make sure that if it's I'm giving you $80,000, if it burns down the day after you move in, I want to make sure there's going to be insurance that will pay me off or cover me for that $80,000. So I'm not going to give you a loan unless I know that you're paying for the fire insurance policy that will cover you for the next year. So that's going to be F1, 1 year of homeowners insurance, fire insurance. Now, if you pay cash for a property, there's no mortgage company telling you have to get insurance. Buy a house cash, you can live there without fire insurance. We don't recommend it. The house burns down, you're out that cash, right? So that's the same thing. The bank wants to be careful. Now, what's the extra 2 months for? Well, the bank is always going to be cautious and think, well, wait, what happens if you get behind on your payments? What happens if you get behind on your payments by a month or 2 months? Okay, the fire insurance, expires. We want to make sure that you're covered. So what'll happen is your monthly payment is going to include 1/12 of your fire insurance. So if you're in this case, it looks like it's about $50 a month is what the fire insurance would be. So when you're making your mortgage payment, you're going to pay your bank $50 per month extra. At the end of 12 months, the mortgage company will have enough money to pay the next year's fire insurance. So you'll never have to bother paying your fire insurance. Your mortgage, as long as you have a mortgage on it, the mortgage company is going to make sure that gets paid because they're collecting the money, over a year. Now, again, they're worried, what if you get behind on your payments? So if you get behind as much as 2 months, they'll still have enough money a year from the day you close that they can afford to pay that insurance for you. So there's always an extra 2 month buffer that starts when you close. So you're going to have to pay 1 year's insurance plus 2 months as a buffer that the mortgage company, what they call is holds it in escrow for you. Okay. The next thing is there's a mortgage insurance premium. That's F2. Again, we want to think about if I'm the mortgage company, I'm always thinking I'm going to lend you $100,000. And I'm worried that you're going to move into that house and the next day, trash it, burn it, who knows what. You're going to just not make a payment and run away. And then what happens if I have to foreclose on you? I'm nervous. Let's say the house is worth $100,000 and you got a VA loan from me. And so I'm giving you $100,000 for this house. If you trash it, run away, I have to foreclose on the property, maybe, I'll have to get the property back, pay to fix it up. hire a real estate agent, pay their commissions and all the closing costs to sell it again, I'm not going to get my $100,000 back. No way. That's not going to happen. I might be lucky if I get $80,000 back. So I'm really nervous about that top 20%, that top $20,000. And so I'm going to make you pay insurance that covers me in case you flake out, disappear, and I have to foreclose on you and get the house back and sell it and cover. I have to cover that top 20%. And so I'm going to charge you mortgage insurance. There you'll see F2 says mortgage insurance premium. There's a blank there. And then G2, it says mortgage insurance per month. There's also blank. The reason that they leave that blank is that mortgage insurance is charged 3 different ways. One way is if it's a conventional loan, they're going to charge you on a monthly basis. So it'll be part of your monthly payment. There'll be an amount, I'll say $100, okay, is going to be your mortgage insurance. And you're going to be paying that until the value of the mortgage is dropped to 80% of the value of the house, which, they'll calculate that, over time. They'll amortize the loan. They'll figure out once your mortgage gets down to 80% or less of the value of the property, that mortgage insurance monthly payment will disappear. Okay. If you're in a rising market, you might actually be able to get that to leave early if you have the house reappraised, a year or so after, or 2 years or 3 years after you move into it. If you're in a declining market, it may take longer. So, but anyway, a conventional loan has a monthly payment. If it's a VA loan, they call it, or the conventional loan will call it a private mortgage insurance. PMI is the term. If it's a VA loan, they're going to charge you an upfront fee. Typically, it's changed over the years, so I don't know the exact figure. You'll ask your loan officer, but it's about 3%. So if I buy a house for $100,000, I get a VA loan for $100,000. They're going to charge an insurance premium of 3% of 100 or $3,000, and it's going to be added to the loan up balance. It's not going to be a monthly payment, but they're just going to charge a lump sum and give you a loan for $103,000. So approximately 3% more than the actual loan amount. They'll add the insurance premium on top of that. And that's going to be the VA funding fee is the name for that mortgage insurance. The third type of insurance is going to be through FHA loans. FHA actually does a combination of the two. They'll charge an upfront fee. Again, check to verify your numbers with your loan officer, maybe 1.5%. So about half of what a VA loan they'll charge upfront and add to the loan. And then they'll also charge a monthly fee, which is going to be about half of what the private mortgage insurance would be per month, so maybe $50 a month. So you might have a $1,500 added to your loan at the beginning and $50 a month. So that's why this form doesn't have exact numbers in there, because they're not saying what type of mortgage it is. The next is you're going to have the prepaid interest on the loan. Now, this is think of this as when you buy a car. Let's say you walk into a car dealership on the 20th of the month. When you walk into the car dealer and you pick out that car, and it's, let's say, $20,000 car, and you've got $5,000 to put down, and they fill out a loan application and they approve it immediately, and they say, okay, the bank is going to give you $15,000, and so you write a check for $5,000, and they get a loan for $15,000, and that $20,000 total is now given to the car dealership, and they hand you the keys to the car and a title. Okay, at that point, you're not going to be making a payment on that loan because you just got the loan, so you don't make a down payment and then a monthly payment the same day. What that happens is you'll make a payment 1 month later on the 20th of the next month for the time that you borrowed that $15,000. So what you're doing is you're paying what they call in arrears. That means you're making a payment. Every time you make a payment, it's for the time that's already passed that you've used the money, that you've been borrowing the money from the bank. It's different than when you're renting, let's say, a house. You move into a house for a rental, you pay on the first of the month, and that allows you access to the house for the future month. Mortgages and loans are different. You make a payment for the time you've already been using the money. So it's paid in arrears instead of into the future. So the difference is that, like I said, if you go in a car dealership, you're going to make your monthly payment. It's going to come every month on the 20th. It'll be reliable and consistent. Okay. However, mortgage companies have determined that people are accustomed to paying rent on the first of the month. And so when they become homeowners, the mortgage payments are made on time, a higher percentage of the time, if the mortgage payment is due on the first of the month. So if you close on the 10th or the 15th or the 20th, they don't want a mortgage payment due on that date every month. They want to arrange it so the payment is due on the first of every month. So let's say you're closing on the 20th. Well, in this case, the prepaid interest, they're saying 15 days. Let's just say 15 days. You're closing in the middle of the month. They don't want you to close on the 15th, let the interest accrue for 2 weeks, and then you'll have a payment that's less than a full payment, because you're only paying 15 days of interest. And it'll come up real quick because you'll have other expenses from the move and the closing. They don't want you to bother with a payment that comes too quickly at the beginning. But on the other hand, they don't want you to wait a month and a half and pay a higher than normal mortgage payment, because then you'd be paying 45 days of interest, and if they waited 45 days for the payment would be much larger than what you're going to be prepared for. So when they close on the property, they're going to charge you the interest on the mortgage, not in arrears, but ahead of time. So you close on the 15th, they're going to charge you 15 days of interest. That takes you up to the first of the next month. So if I close on the 15th of March, I'm not going to have a payment due on April 1st. I will have a payment due on May 1st, 45 days later. So there's going to be a delay after you close before you have a payment due. Typically, it's not going to be more than 31 days. If you close on the 31st or 30th or 31st, last day of the month, you're only going to have 1 or 2 days of prepaid interest to make. If you close on the 2nd or 3rd or 4th, you're going to have 26, 27, 28 days of interest, prepaid interest. It kind of balances out, because if you close at the beginning of the month, yes, what it takes to close the deal is going to be more. You're going to have a larger amount to pay. But then your next payment is not going to be for almost 2 months. But if you close at the end of the month, there'll be less it takes to close, but your next payment will come up quicker. So you just want to be aware of how that affects. And when you're negotiating, talk to your real estate agent. If you're there'll be language in who pays your closing costs, because you can negotiate for the seller to pay some closing costs, and they might limit how much they're able to pay, or the contract might say they'll pay all the prepaids. And if you don't have a limit on what the seller is going to pay for your closing costs, you want to go ahead and close near the beginning of the month, because then the seller is going to pay more. And you're going to have a longer time before you actually have to make your first monthly payment. So it really depends on how your offer is structured, your contract is structured. So that's one of the things you want to look at when you're negotiating the deal. The next thing is the property taxes. You'll see in F4 and G3, it says property taxes 6 months, and then property taxes for 2 months. So the 6 months may or may not be the number of months that needs to be paid. The thing of property taxes is they're not going to be due based on when you close. Each county, each state determines when property taxes are due. Some are due every 6 months. Some are due every 3 months. Some might be due 4 times a year, but not in exact 3-month intervals. So what will happen is the seller it will have paid taxes ahead of, up to a certain point. Let's say they've paid till June 1st and you're closing on April 1st, 2 months earlier, and they paid the month before that 3 months. So maybe they paid ahead 2 months of taxes. So when you close on the transaction, typically you're going to pay whatever the seller's prepaid to. So you're going to reimburse the seller for what they've prepaid in the taxes. They have on here 6 months, basically because that's typically going to be the longest period of time that would have been prepaid on taxes. Anyway, the other thing is they're going to have an impound account. Again, if you have a loan on the property, the mortgage company wants to make sure that the property taxes are paid, because if the property taxes aren't paid, they can grab the house away from you and the mortgage company. The government always comes first. Okay, so the mortgage company is going to want to make sure that not only do you, when you close, are the property taxes paid up to the next interval, but they're going to want another 2-month buffer, just like on the fire insurance. They want to have an impound or a buffer in case you get behind on your payments, because they again will be paying the property taxes for you. The property taxes on here, it says $105.30 per month. That'll be part of your monthly payment. The mortgage company will collect that $100 a month, and then when it's time to pay the property taxes, they'll make that payment for you. Again, unless you don't have a mortgage or pay cash, you're going to have to pay it on your own. The next few things, I'm going to scroll down a little bit, are going to be the section H, the HOA capital contribution fees, the processing fees. HOA stands for Homeowners Association. So if you're buying a house that is in a Homeowners Association, there are fees involved in transferring the ownership of the property. Capital contribution is a lot of Homeowners Associations will require any new members to contribute to the capital funds. But that's going to be different based on every homeowners association. There's hundreds of thousands of them across the country. There's also home inspection fees. You may, as a purchaser, waive a home inspection. However, we highly recommend that you do a home inspection. Also, home warranty company. There are many good home warranty companies out there. Have your real estate agent recommend one or give you several options to choose from. And then I'm going to slow down a little bit here, because you'll notice there's a number of different columns. You can pay for some of this stuff up front, either the buyer or the seller, or it could be paid at close by the buyer or the seller. Typically, a home warranty is going to be paid at the close of escrow, and it'll be negotiated by, on the contract, whether the buyer or the seller pays for that home warranty. Home inspection fees typically are going to be paid at the time of the inspection. Most inspectors will come out to your house and they're going to say, give me the money and I'll start the inspection. So, and that's the same with things like appraisals. Typically the appraiser is going to want to get paid because if it doesn't close, he's still done the work. Same with the inspectors. If it doesn't close, the inspector still spent the time and they want to get paid for that. A home warranty, typically, if it doesn't close, they don't get the money, and so you can order the home warranty early, and it doesn't necessarily, you don't have to pay for it until it does close. And then, of course, real estate commissions are typically paid at the close of escrow, and it will be split between the buyer's agent and the seller's agent. And then there's also the title insurance. There's a H7, title, owner's title insurance optional. Rarely do you buy a house without title insurance. That basically ensures the buyer that the seller has a right to sell the property to you. You don't want to buy a house from somebody who's pretending to own it, that's just a tenant in the property. You want to make sure that whoever's signing that paperwork really has the right to sell the property to you, and that's what the title insurance does, is it ensures you that the person selling it to you is the owner and has the right. There's many legalities involved in that, and I could do a whole hours of training on what issues could come up with the title insurance. Okay, so that gives you an idea of the lower section, other costs. I'll go ahead now and cover the loan costs. We'll start with the origination charges. The first thing is they have this says 0.25% of loan amount points. Talk to your loan officer to determine exactly what that's going to do for you. Typically, if you pay points, that's going to adjust the interest rate on your mortgage. So you want to take a look at the options that they give you. A lot of times if you pay more money up front, you'll get a lower interest rate, which lowers your monthly payment. So you want to calculate if it makes sense to you. If it costs you $1,000 to reduce your up front to reduce your monthly payment by $50, that means it'll take 20 months for you to recover that $1,000. And 20 months is less than 2 years. That's a pretty good investment, because after the 2 years, you're saving that $50 a month every month. So if you're the thing is, if you're gonna live there for more than 2 years, it makes sense to pay $1,000 to save $50 a month. Now, if it costs you $5,000 to save you $50 a month, it's going to take you probably 5 years or more to recover that money, and you may not be planning on living there for more than 3 or 4 years. So then it wouldn't make sense. So you want to make those calculations with your loan officer to determine whether it makes sense to pay discount points to reduce your monthly payment. There's also going to be on line 2 an application fee, or 3 underwriting fee. There are other fees you'll see. There's warehousing fees I've seen. A number of different fees that would be one-time charges. That is going to be one of the things you could compare from one loan officer or company to another. Sometimes they'll offer you, super low interest rates on your mortgage payments, but then not only do they have the discount points, but a lot of these other fees are tacked on top of it. And so you want to be careful and get a disclosure as far as what all those fees are, and you can use those to compare, from one company to the other. Next, you look under Section B, under loan costs, services the borrower did not shop for. Typically, these are going to be things that the mortgage company, directs, like an appraisal fee. You don't get to pick the appraiser. In fact, the mortgage company, unless they've changed the rules recently, can't pick an appraiser either. It goes into, based on if it's a government loan and other things are involved. But there's a separation of appraiser from mortgage company, and typically they're going to have to, select an appraiser through an approved process. There's also going to be a credit report fee. Typically, you're gonna, they're not going to lend you give you a loan unless they check your credit report, and there's typically a fee for that. A flood determination fee and flood monitoring fees. There may be other names for these, but they basically are involved in the process of checking to see if your property is in a flood zone. If it is in a flood zone, there's different types of flood zones, but if it goes into a certain flood zone and has a certain amount of risk, the mortgage company is going to say, we're not going to lend you money unless you get flood insurance, which is separate from homeowners insurance. So you would just want to be aware that your fire insurance, your homeowners insurance, is not flood insurance. And even if you're not in a flood zone, you may consider getting flood insurance. The way the weather's been changing, we've been hearing of all these disasters, so you might want to check into that. There's also a tax monitoring fee, which is going to involve checking with the county assessor's office and tax collectors to make sure the taxes are paid. You don't want to buy a property if the taxes are way past due. You want to make sure those taxes get paid before you own the property, and so you don't inherit somebody else's tax debt. And then also the tax research fee is involved in that same issue. Again, talk to your loan officer to get more specific details on whether you need 2 of those fees or just 1 would do enough. So also there's going to be the services the borrower did shop for, Section C. Pest inspection fee. Again, you're going to have a home inspection, which typically covers the structural and mechanical aspects of the property, and then a pest inspection, they'll check for things like termites. No matter where you're at, there could be termites. I lived in Las Vegas for many years, and everybody said there's no termites here, but there actually are. There are subterranean termites. I sold hundreds and hundreds of houses, but I never ran across termites. But I always had a pest inspection just to be safe. Also, a survey may or may not be necessary. Again, that's going to depend on what type of property you're buying. If you're in a subdivision, and is clearly lined. There's walls on the property lines everywhere, and it's platted out. Typically a survey isn't really required, but if you're buying a large piece of property, a ranch, and the lines between properties are not well defined, you may want to have a survey done just to verify and clarify exactly what it is you're buying. Now the title insurance binder, these are things, I mentioned that earlier, and I'm not sure why they have it in two places here, because the title insurance is going to be ensuring you that the seller has the right to sell the property to you. Then there's a title lender's title insurance. So whenever you get caught, if you have a loan, again, if you pay cash, this isn't an issue. It doesn't need to be paid for. But if you have a mortgage, your mortgage company is going to want to have a rider added to your title insurance policy that covers them in case, let's say you buy the property and the previous owner didn't disclose to anybody that he had gotten married and then he got divorced, and the title search didn't show up, and it's a common law state, that ex-wife could come knock on your door and say, this is my house, get out, and you'll have to do it. But the title insurance, if they missed that and didn't put it as an exclusion to the policy, then they'll have to pay you back for what you paid for the property. Anyway, the title insurance binder for the mortgage company is to ensure them that you have the right to own the property. And then the settlement agent fee is going to be, what escrow company fee. There's a disinterested third party, typically an escrow officer, depending what part of the country you're in, somebody that will only take will only act upon mutual written instructions from both the buyer and the seller. So what that means is the escrow officer, the seller could sign the deed the day after you do open escrow or have a purchase contract, weeks and weeks or months before it actually closes. The seller can sign the deed and give it to the escrow officer. The escrow officer is bound and responsible for holding on to that deed until the buyer has actually provided all the money. And whether the buyer's money is going to be in the form of a loan and a down payment. So once the buyer has provided all the funds to close and the seller has the deed, then they can record the deed and then take that money and distribute it to the seller and the real estate agents and anybody else that is owed money from those fees. It doesn't all have to occur at the same time. On the East Coast, a lot of times you get what they call closings, and everybody sits around a table and everything happens at the same instant. Out West, typically, you can do this everything separately, and especially with this 3-day waiting period, it's a little better model to actually comply with the 3-day requirement because, like I said, the seller can sign the deed, buyer can put the money into escrow for the down payment immediately, and then the loan can go in, and they don't have to close the next day. They could, then the seller can put the deed in the day after that. So it doesn't matter what order these occur in, as long as they all have to occur, and then you can close. And like I said, it's like the dominoes. If you get everything done, once all those dominoes are set up, boom, it'll close. Anyway, that's pretty much a discussion of all these fees that are involved. Hopefully that'll clarify the process for you. If you are looking to purchase or sell a house and you don't have a real estate agent, I recommend that you hire a real estate agent that uses the TRANS-TRAC system, which I designed. I sold up to 75 houses per year for 18 years in Las Vegas. And what you'll see here is this system is a spreadsheet that can be shared between a real estate agent and their assistant. There's 31 steps. I'll scroll across for all the different steps for closing a deal from the time they list a property till they close it. And this will be a system that allows your agent to comply with that 3-day waiting period and allow them to remember to do all these little things that are needed to set all those dominoes in place. There's 31 dominoes here that all need to be taken care of, and this is a system that will allow them to do it. And when they, the way for them to do it is to go to udemy.com/trans-trac TRANS-TRAC System. The price retails $149, and if you go to the link at the bottom, I'm providing a coupon code for a discount. Realtor 99 is a coupon code, and it'll be $99, $50 off. If you could buy it if you're a home purchaser too. You'll not need it on a regular basis, but your real estate agent should be buying it, and if they don't have it already, and that will help you avoid the headaches of any delays in closing. So this system is available on this website, along with 39 lectures, video lectures, tutorials on how to use the system and how to accomplish each of the 31 steps from the time you list till they close. So I hope this was educational for you home buyers and for your real estate agents. If hopefully it's educational for you and you've gotten some benefit. You can also send your clients to watch this video for these explanations as well. Again, purchase the udemy.com/trans-trac-system real estate transaction tracking course, and you'll get access to the TRANS-TRAC system to manage your real estate business and stay on top of things and comply with that 3-day new period that's coming up on October 1st. Have a great career, you real estate agents, and enjoy your new home buyers.